Yes, it's being recorded. So we say that Altman's z-score, Altman's z-score, the formula is that z is equal to 1.2 x1 plus 1.4 x2 plus 3.3 x3 plus 0.6 x4 plus 0.999 x5. That is what we were given, but normally we have this as 1. We normally have this one as 1. We just write 1, but you can round it off. Sometimes I'm saying that sometimes examiner can change this so that we have this one as x4 and this one becomes x5. Doesn't matter, just look at the instruction that you've been given. You need to know where x4 is and x5 is according to the illustration. Because they will tell you that x1 represent this, x2 represent this, x3, up to x4 and 5. So therefore, we can be able to look at this particular question. And we are saying that you can always, ordinarily, it is normally gotten like this, or mass. Just like that, or mass. So we're saying that this one is working capital. Of course, it is net working capital all over total assets. I didn't see it in last sitting, so it might come this time. We have this one, retained earnings. All over total assets. We have this one, EBIT. Lower total asset. And then we have the market value of ordinary shares all over the book value of debt, all over book value of debt. This one, they always call it, sometimes they call it equity. So equity and ordinary shares are basically the same. Equity and ordinary shares are basically the same. Then the last one, we have sales all over total assets. So what you can see, you'll be able to notice that everything is over total assets, except MAR, that is market value of ordinary shares. Ordinary shares are sources of capital, and debt is also a capital. So the only thing that is different is a capital. Why we have this one, capital of the owners all over debt, right? Now, that's basically the way formula is given. However, the examiner can give it the way they want. If they give it like that, it'll be okay. If they change anything, they will tell you what has changed. Now, we need now to get, they are saying that after giving you all this information, the information is very simple here. Let me share with you the screen. After giving you the income statement, which is this one, so that you can get more information from here, they have also given you the position, financial position. You see now, normally when students see this kind of question, they think like the examiner has forgotten to bring AFR in an FM paper. It is not like amesahau. Amekupea kazi, utafute, all right? So you go and do the work. Which year? Please, this is November 2020, November 2020, question number 1B. Now, they are saying that in this model, a z-score of 2.7, that means that it is a sign of z-score of 2.7 or more indicates no signs of failure, and a z-score of 1.8 is or less is an indicator of failure, an indicator of failure. The firm's ordinary shares are currently trading at 15. So why are they giving you the 15? They are trying to give you the current market value of the shares, right? That is why they're telling you shares are currently trading in the market, because what you're going to get here is par value. Most likely what you're going to get in the financial statement is the par value of shares if they give you, but here they have not given, so that is fine. Another thing that you can notice is that they are saying that is market value of ordinary shares. So you need to know how many shares are there so that you get their value. And they are saying that it is debt including preference share capital. So that means that when you'll be getting the denominator. You have the ordinary shares all over a denominator. Denominator is debt plus preference shares. So you simply come and add debt. Where are the debts? The debts are 40. Debt is 80. Preference shares is 40. So that is a book value. These are the book value, what you are seeing in the book here. But for shares, we shall get the ordinary shares only, not retained earnings, not premium. The ordinary shares only. The par value is 10. So you can divide 100 by 10 to get the number of shares, right? You can know the number of shares by dividing this. Those shares you multiply with 5 or by 15 to get the market value. Si hapo uko sawa? Mshamaliza hiyo story. So you can be able to do that. That is the only thing. They are not even trying to confuse you. They believe that you understand. Now the Z-score of alpha. So what do we start with? Z-score of alpha. So let's start with the working capital. We started yesterday by looking at what working capital is. And Luke said that working capital is current assets minus current liability. So we need to go and check our working capital. Working capital is equal to current asset minus current liability. What do you get there? Current asset. Go back here. We have current asset, which is 100. Do we have current liability? Current asset, we have finance by retained earnings, blah, blah, blah. We have current liability. Yes. Total current liability is 20. So it is 100 minus 20. Maana vile ni rahisi. Ama mtu hajaona. Wacha nimuonyeshe. Let me show somebody. We have current asset here, 100. Then we have current liability. That is what we call working capital. So we are going to have 100 minus 20. You have 80, right? Now that is 80. And we are saying that it is all over total asset. So our working, we shall have our 80, that is X1. X1 is equal to 80. Our current asset is, total asset is, and please kindly pray so that this kind of questions to come in exam, so that they can make you pass within the first hour. Total asset is 400. Yani within the first hour, we shall Peter. The first 1 hour in exam room, you are done. I was told that this one I can do like that. So this one you can give us 0.2. Can somebody confirm? I'm not very sure. Kindly confirm. If that is true, then we can say that now this one is equal to 1.2 times 0.2. That's the first one, plus. I need somebody to confirm. Anyway, I'm gonna calculator. So let's get the first one. So we are done working. We are now on retained earnings. So retained earnings all over total asset. What is the retained earnings? Waremas. We are on retained earnings. Given here, retained profit, which is 120 all over. Retained profit is 120 all over total asset, which is 400. 120 over 400. So we are going to have 120 all over 400. So we do that. Then we were told that this can be like this, so that we have 0.3. So we have 1.4 times 0.3. Then we have 33 point times EBIT. EBIT. All of our total asset. What does that mean? Our EBIT is? EBIT is the same as operating profit. EBIT is basically operating profit, yani profit before tax. Did they mention operating profit somewhere? Operating profit here. That is earnings before interest and tax. So we need to remove the interest and remove the tax. But we are saying that earning before interest and tax, which is 40. EBIT, earning before interest and tax, is called operating profit. So we have 40,000 all over 400, right? This one seems to be 0.1. This one seems to be 0.1 plus 0.6. Hapa ndio sasa tulisema tutacalculate. You simply look at market value of ordinary shares. So the par value of shares we know, we have been given. That is the value of shares at the time they were purchased, the original value of shares, not the trading. So initially they were at 10 shillings each, and they're giving us a total of 100,000. So that is how many shares. So we are saying that the number of shares is equal to 100,000 divided by 10 shillings. And this will give us 10,000 shares. The market value, MPS, that is market price per share, the MPS is equal to 15 shillings. 15 shillings. Therefore, we are saying that now 10,000 shares times is equal to what? So this one is for one share. 10,000 will be 10,000 times 15. So what is the market value? It is actually 150 shillings. We have done that. So we know the market value. And now we are told that we need to have the value of debt. Preference shares plus debt plus debentures or long-term debt. Debenture is the same as long-term debt. So you come here and get your long-term debt. So the preference shares are 40, the debenture is 80. So we are done 120. So the total debt is 120. Therefore, we are saying that now our answer should be 150 all over 120. What do you get? What do you get? What do you get? This one you do that, this one like that, this one 3 goes here 4, 3 goes here 5. 5 divided by that, unapata 1 point. 1 point what? 1.25, right? Confirm if it is 1.25. Confirm if it is 1.25. You come here and write your 1.25 plus 0.999 times the sales all over total assets. So the sales value, you'll realize that sales are given here, that the total sales is 400. So we have our 400 all over 400. Total asset is 400, so our sales are 400,000 all over 400 total assets. This one gives us something like a strong 1. So you have this one times 1. Could you kindly take your calculator and confirm for me the figures so that we tell the examiner that this thing, we are the professionals, we are the pros. Can we prove to the examiner that these things are very simple, they are very easy? Prove to the examiner that you attended class. I'm waiting for your answers. So you're getting to point 7.3. So your Z score value is equal to 0.739. What is your conclusion? Topista, welcome. Kindly take a photo. Mute yourself, Topista. Thank you. After muting yourself, take a screenshot of this. We were looking at a question of 2020 November. Question number 1B. So take the screenshot because we might move. So I thought total liabilities should be 20 plus 40 plus. What do you guys think? They say the value of debt plus preference shares, not liability. They are very specific. Debt. That's the long-term debt and the preference shares. They are not saying liabilities. And when they talk about debts, that is a long-term debt. So that is the venture. Your manner, the examiner is very specific. I may mention debt. Those are long-term liabilities. Is there anybody with the contrary answers? Ruth, Are you getting contrary? If you use that formula that you're using, what are you getting? If you use that one that you're using, what are you getting? You're getting 4.7. Okay. And let me see that option that you're saying. So that we have that was 150 all over. So we are only trying to prove this one. 150 all over 160. So this one you're going to have, what will be the answer there? 0 point. $16. 9375. 0.9375. 0.9375. So if you have that one here, what are you getting? 0.93, 0.6 times 0.9375. If you get that one, I think it should be even less. Is it? It should be even less. Ama hii ni nini nimeona umeandika? Did you say 4 point something? Huh? I thought I saw you typing 4 point something as the total answer. Fine, I'll find out about that. But the formula says the value of debt. So I'll find out and get back to you in the next class, whether it should be inclusive of current asset or just the debt. So I want us now to look at other Altman's model, other models apart from the Altman's. You're getting 3 point. I think it should be less because this one, we are having a higher figure. If this was correct with this higher figure, when we reduce this one, it should be less, unless this one was wrong, unless this was wrong. Okay, so that is basically how it should be done. So I'll find out, then I'll confirm to you even through WhatsApp, whether it should include current assets or it is exclusive of current assets. I want us now to look at other models, other alternative models of predicting corporate failure. The first one is called Argentines model. So we have Altman's as number one. Altman's model. Number two, we have Argentines model. So I want to make some notes about this and say that this model is based on the calculation of scores. The calculations of scores are related to company defects. It is based on the calculation of scores It is based on the calculation of scores relating to. It is based on the calculation of scores relating to. It is based on the calculation of scores relating to company defects, comma, management mistakes, and symptoms of failure. It is based on the calculation of scores related to company defects, management mistakes, and symptoms of failure. Symptoms of failure. Symptoms of failure. Company defects include Company defects include a passive board, that is the board members. Company defects include a passive board. Company defects include a passive board, an autocratic chief executive, an autocratic chief executive, an autocratic chief executive, an autocratic chief executive, and weak budgeting control. And weak budgeting control. And weak budgeting control. And weak budgeting control. Full stop. The next paragraph. Management mistakes include high levels of gearing. Management's mistake includes high levels of gearing. Management mistakes include 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 high levels of gearing, comma, failure, failure, failure of large project and overtrading. Failure of large projects and overtrading. The next paragraph you say, system decline include system declines include system decline include deteriorating ratios, comma, quality and staff moral, deteriorating ratios, quality and staff moral, and the use of window dressing when preparing financial statements. And the use of window dressing when preparing financial statements. And the use of window dressing when preparing financial statements. And the use of window dressing when preparing financial statements. And the use of window dressing when preparing financial statements. The use of window dressing when preparing financial statements. And the use of window dressing when preparing financial statements. And the use of window dressing when preparing financial statements. And the use of window dressing when preparing financial statements. And the use of window dressing when preparing financial statements. And the use of window dressing when preparing financial statements. And the use of window dressing when preparing financial statements. And the use of window dressing when preparing financial statements. And the use of window dressing when preparing financial statements. And the use of window dressing when preparing financial statements. And the use of window dressing when preparing financial statements. And the use of window dressing when preparing financial statements. And the use of window dressing when preparing financial statements. And the use of window dressing when preparing financial statements. And the use of window dressing when preparing financial statements. And the use of window dressing when preparing financial statements. And the use of window dressing when preparing financial statements. And the use of window dressing when preparing financial statements. And the use of window dressing This model is based on past company data. This model is based on past company data. Now, what we are saying here is that this model called Agentis is based on information as far as the management of the company is concerned. If you want to know that this company is failing, you look at some of the historical data, the information that you have. And we say that these informations are categorized. They include the management, mismanagement, includes company defects, and symptoms of failures like the decline on ratios. So you don't need to calculate a lot of things. You simply look at the way the management are doing their things. You have a CEO who is autocratic. You can't advise him. His word is final and is making wrong decision. That is a symptom of failure. That is management issue. The next one, when you have a passive board members who are not actively managing the company, wamelala kazini. When you see board members that are passive, that is an agent of failure. Under managerial mistakes. So managerial mistakes includes the gearing levels. If the gearing level is high levels of gearing, the company is taking a lot of loans, over trading, failure of large projects, they start projects which do not go through. Those are mistakes. That is how you look at it. The next one is now called Tapler's model. Number 3 is called Tapler's model. Tapler's model. So if the examiner asks you that apart from Altman's model, which other models can you use to predict company failure? You tell them that you have a JT's model that looks at issues to do with the company defects, management mistakes, and other symptoms of failures. This includes how the management is borrowing, the nature of or characteristics of the CEO, like autocratic CEO, the levels of gearing, that one is the same as management borrowings, qualities of staffs that we have. You have incompetent staffs, that is an agent of failure. We have staffs who are trying to cook books like window dressing. They are trying to cook books when they are preparing financial statement. That is a symptom of failure. So those things you don't need to be reminded. If you are working in a company and you are seeing those things, just know that hii kampuni inaenda chini. Before even you calculate the financial performance, ushajua kuna shida. Those are other models of predicting corporate failure. So the next one is called Tapler's model. Say that this model is based on the following series of ratios. This model is based on the following series of ratios. This model is based on the following series of ratios. The first ratio, it is based on the following series of ratios. The first ratio is sales all over total assets. That is Roman 1. Sales over total assets, Roman 1. So the first ratio is sales all over total assets. The next one, current ratio. So these are the ratios that is based on. We have sales all over total assets. The next one is current ratio. The third one, reciprocal of the current ratio. The fourth, earnings before tax all over current liabilities. All over current liabilities. Then you proceed and say that it is a quantitative model. It is a quantitative model. It is a quantitative model. It is a quantitative model that uses accounting data to predict corporate failure. It is a quantitative model This is a quantitative model that uses accounting data to predict corporate failure. Let's look at the next one. The next model, that is number 4. It is called Beaver's failure ratio. Number 4 is called Beaver or Beaver. I don't know how you read it. Beaver's failure ratio. It is called BR. Beaver's failure ratio. BR is equal to operating cash flow all over total liability. Operating cash flows all over total liability. Then you proceed and say that it shows the firm's ability to cover its total obligation. It shows the firm's ability to cover its total obligations. It shows the firm's ability to cover its total obligation from the current levels of operations. From the current levels of operations. From the current levels of operations. It shows the firm's ability to cover its total obligation from the current levels of operations. The lower the ratio, the higher the chances of corporate failure. The lower the ratio, the higher the chances of corporate failure. We are saying that it shows the firm's ability to cover. It shows the firm's ability to cover its total obligation. Shows the firm's ability to cover its total obligation from the current levels of operation. From the current levels of operation. Full stop. From the current levels of operation, full stop. The lower the ratio, the higher the chances of corporate failure. The lower the ratio, the higher the chances of corporate failure. The lower the ratio, the higher the chances of corporate failure. The lower the ratio, the higher the chances of corporate failure. The lower the ratio, the higher the chances of corporate failure. The next one is called Zeta model. Zeta model is also called trade market. Is also called the trade market. Not trade market, but trade market. Zeta model or trade market model. Zeta model, bracket trade market. Model. You say that it is an extension of the Z-score model. It is an extension of Z-score model. It is an extension of Z-score model, which incorporates some additional ratios. It is an extension of Z-score model. It is an extension of Z-score model. It is an extension of Z-score model, which incorporates some additional ratios, such as return on total assets, such as a return on total assets, which incorporates some additional ratios, such as return on total assets. Also, liquidity ratio and earnings stability ratio. Liquidity ratio and earning stability ratio. Liquidity ratio and earnings 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 stability ratio. It is also called Zeta credit risk model. It is also called Zeta credit risk model. It is more accurate than Z-score. It is more accurate than Z-score. Number 6 is called KMV approach. KMV approach. You say that it uses market-based quantitative techniques. It uses market-based. It uses market-based. It uses market-based quantitative techniques to assess credit risk. It uses market-based quantitative techniques to assess credit risk. It uses market-based quantitative techniques to assess credit risk. That is number 6. We are going to number 7, which is the last one. It is called, number 7 is called Springate model. It is called Springate model. Springate model. Springate model. Now, before we go to number 7, I was trying to refer to our earlier example that we did yesterday about the Z-score model. And I can see we were having liabilities. They call debts liabilities. So I think Ruth was right. We shall be using liabilities. That is the total liabilities, both current and long-term liabilities, instead of considering debt only. Because either way, debt is also a liability, as short-term liability is also a debt, right? So we will look at that when you'll be doing such kind of question. Add both total, and then both current and long-term liability. I can see from the example that we did, 2022, they simply call it liabilities, meaning that the only thing that is left out is the equities. The only thing that is left out is equity. So I think that is clear. Go and review what you did. Have the total liability, use 150 all over 160 and calculate and get your correct answer. That's the only adjustment we need to make there. Otherwise, you're good. So that is quite clear. Let's look at the Springate model. It is a model used to assess the financial health of a company. It is used to assess the financial health of a company. It is used to assess the financial health of a company. It takes the following formula. It uses the following formula. It uses the following formula. So formula for Springate. Na iko na formula kama Z-score. Yake inaitwa Z is equal to 1.03 A plus 3.07 B plus 0.66 C plus 0.4 D. That is the formula for Springate. So I want us now to look at an illustration on how to do this. So where A is net working capital all over total assets, B operating profit all over total assets, then C net profit before tax all over current liabilities. Then we have D sales all over total assets. Sales all over total assets. Sales all over total assets. I want us now to look at a question. Let me see the setting that might have this one. 2019. Question number 3C. Which year is this? 2021. December 2021. Which sitting? December or May or September? December. Can I spring it? So this is December. Is it this one? India 3C, ama? I will share that question on WhatsApp. share the question. Naona watu wanatoroka, wanataka example. I think this one is question number 3. Ama which sitting is it? Yes. Okay. December 2021, question number 1. So it is shared on WhatsApp. This can be, no, December is when the syllabus was changed. I think this could be the pilot paper. Must have been the pilot paper. Anyway, we can do it, eh? The following data, I hope that you guys have the question now. Is a pilot paper 2021, not the main sitting. You have it on WhatsApp. The question says that the following data relates to Kaban, a company that operates in manufacturing sector for the year ended 31st December 2020. We have sales, total assets, total liabilities, retained earnings, net working capital, earning before interest and taxes, market value of equity, the book value of total liabilities. The company is currently paying interest on a long-term debt instrument amounting to 905,000 per year. That is Kenya shillings. And the company's total liability is constituted in the ratio of 2.225 between current and non-current components. Using the Springate model, assess the financial health of the company. Note that the Springate model takes the following form. So the formula is given here. Z is equal to 1.03A plus 3.07B plus 0.66C plus 0.4D. Whereas the A, B, C, and D refers to this. So we are told to use the Z-score model. So how do we start? And with the Z-score, in case you find for figures for Z-score below 0.8, for Z score below 0.862, the company is in distress. So if you find Z score being below 0.862, then the company is in financial distress. Just like we were having for Z score, if the value of Z is less than 1.8, then it is in financial distress. In financial distress. If it is greater, so this one is a failure. 2.7 and above, or above 2.7, success. That was the interpretation for Z score, but this one is the interpretation for the Springate model. So we can calculate and then we give our conclusion at the end. Now, what do we start from? A. So A, we are told that A is net working capital over total assets. From the information that we have, what is the value of net working capital? Net working capital you are given as negative. They have written it there, net working capital negative 1,777. So we have negative 1,777 all over total assets. Total assets you are given theirs. Total asset is 49,579. We have 49,579. What is the answer? Then we have our C, our B. B you can calculate as well. B we are told operating profit. Are we given the operating profit here? What is the value of operating profit? Operating profit, we said that it is the same as EBIT. Operating profit is the same as EBIT. That is earning before interest and taxes. So we have 2605. All over total assets 49,579. Which answers are you getting? Then we have C. C is net profit before tax. Net profit before tax. So how do we get net profit before tax? We have profit before interest and tax, that is earning before interest and tax, and then we have now before tax, meaning that after interest. So can somebody tell us how we can arrive there? Net profit before tax. Somebody to unmute himself or herself. They are saying it is 2605 plus. What am I seeing? Kwani una type ukidelete? Una type ukidelete. It should be minus, not plus, because we are removing something. We need to remove interest. So this one, net profit. So C, we know is net profit before tax. So we are saying that net profit before tax, or which is the same as profit before tax, is equal to EBIT minus interest. Are we given interest? The question says that the company is currently paying interest on a long-term debt instrument amounting to 905. So that is the interest that is being paid. So you need to take EBIT, you minus interest, so that you remain with EBT. So our EBIT was 2605 minus 905. That is the interest that they are paying currently. What do you get? We are having 2605 minus 905, 1700. That is the profit before tax, but profit after interest, immediately after interest, but before tax. All over current liabilities. What is the total current liability? Are we given? We are told that the total liability is 544. 5044. Anything else that we're given here that can help us get it? We are told that the company's total liability is constituted in the ratio of 2 to 5. That is a current to non-current. Total liability is constituted. We are looking for current liability. In the question, we are only given the total liability. They have not splitted for us the current and non-current. Tunaelewana? In the question, they told us that the total liability is 5044. 5044. That is the total liability. With us, we want only current liability. And the current liability, the liability that has been provided, is constituted of 2 to 5. That is the current and non-current. So it means that 2 to 5, this one is non-current, this is non, this one is current. Current, this one is non-current. So the total liability is 7. So you simply say that if 5044 is equal to 7, that is the total liability. Therefore, 2. Therefore, what will be equal to 2? We shall have our value here, where we are saying that now 2 times 2 over 7 times 5044. The total is 7. So it is just 2 over 7 that is current. 5 over 7 is long term or non-current. You get this value, you'll be good. Get me the figure. What are you getting? 144. 1. So that is the current liability. That is the current liability. So now we can get our C. This one is 1700. So the C is equal to 1700. Our current liability is 111. Get me the figure. And then D is sales all over total assets. Sales all over total assets. So what was our sales? Our sales was 25,678. 25,678 all over total assets. Total asset we were having 49. This one 579. Get me all these figures and then we are done. That will be the end of topic number 5. Get me the figures. I'm waiting for the figures. So I'm waiting for the figures. You guys are silent, really. Instead of just telling me that this one divide by this, 49,579. Instead of telling me that this one is 0.0358, this one is 49. This one is 0.0525. Instead of giving me these answers, mmeamua kunyamaza so that we waste time here. You're getting Z score to be 1.0991. That is the value. Are we all getting that to be the value? Let me confirm. That plus this. I'm getting a different answer. So where am I getting it wrong? From where? Huh? Mine is 1.110801. I don't know. Now that depends on the accuracy level. So you can be able to check if the figures were accurate. Because I'm using my phone. You refuse to give me the figures. So I'm using my phone and that is what I could get. So we say the interpretation was, in either case, any figure that is less than 0.862, that is where we have a problem. But whether you have gotten what Ruth has gotten, or mine, or the one for Mercy, all those figures are more than this. Right? They are less? No, it was 1 point. Did I say 0 point? It should be 1.8. 1.862, not 0.862. The perimeter is 1.862. 1.862. 1.862. So let's stop there. That should be the end of today's class. Unless somebody has a question. In our next class, we shall start topic number 6. Topic number 6, there are areas that are very important. You cannot afford to miss. Topic number 6, we shall be looking at the foreign exchange. We shall be looking at the forward market and money market and arbitrages. Those are areas that must come in exam. It is called financial risk management. How do you manage risk in financial management? Risk management in finance. So instead of borrowing in one country, you can borrow in another to manage risk. So let's meet tomorrow and cover that area. Thank you so much.